You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to reclaim, reconnect, and refocus their life by bringing you the top real estate professionals in the industry. We'll help you diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, thanks for jumping on for another episode of the Reinvest Podcast, episode number 87. We are creeping towards 100. And if everything goes right, we have a really cool guest that we hope to have on for episode 100. So that'll be one that you'll want to tune in on. We know that you listen to every one of our episodes, but that especially will be one. So, and if you're watching on YouTube, we have somebody back in the studio today.
It's me. I'm back in the studio today. Yeah, I missed the last couple episodes, but it's good to be back. It's good to be healthier again and stronger and better than ever. So
they tried to keep you down,
they did.
Whoever they is, and they did not succeed.
The powers that be tried to keep me down.
That's right. So we got a great episode for you today, and joined with us, our guest is Chris Miles and his company, Money Ripples. Chris, how are you?
Man, fantastic. Garrett, Seth, glad to have you back, man.
Thank you. It's good to be back.
In the flesh. And Chris, you're in Utah, real estate guy, but you kind of have an interesting vantage point because you weren't always a real estate guy.
Yeah, I used to tell people not to invest in real estate. Isn't that awesome?
That's blasphemy. But.
Yeah.
Awesome. So Chris, why don't you tell us a little bit about who you are, talk about Money Ripples, and then let's kind of reverse engineer, go all the way back to the beginning, and tell us how you got here.
Yeah, I mean, besides being the father to 8 kids, which, 6
my word,
2
nice.
bonus kids.
You kind of sprinkled that in there.
Well, I mean, if you're from Utah, you got to, I mean, it's either like you're in the Midwest, you're Catholic, or you're Mormon in Utah, right? So it's got to be one of the two, right? But
right.
Yeah, so like, obviously I have a great family here. I'm actually originally from Portland, Oregon area, grew up there. And, my dad was very much kind of the hardworking kind of guy, right? The typical guy you think about is in the automotive industry. He was always the one that taught me your word is your bond. You got to work hard to get what you want out of life. Not always work smart, but at least work hard. And, and so I was raised with that. But when it came to money was the one thing that really was not taught to me other than you need to save everything you can, right? So I was taught very much that like Dave Ramsey, desperate broke mentality, of like save everything, spend nothing. And even growing up, you hear things like, I can't afford this. What do you think I am? Made of money? Money doesn't grow on trees, those kind of phrases you hear from parents growing up. And so I didn't want that life. So when I went to college, I realized quickly the typical employee path wasn't the way to go, right? Like you're going to be limited. You're going to be capped at what you want to do. And I want to control my time, my freedom, my money, and everything else. So I was going to become a business owner. And in fact, I was going to become a business consultant. I figured, though, if I'm going to do that, shouldn't I have real life business experience rather than just getting an MBA? So I actually dropped out of college with 1 class to go before I got my bachelor's. Supposed to be just a temporary one year break, like
Sounds
a little
like
sabbatical.
A bad idea.
And I was like, well, what business do I start? Well, the first one that kind of intrigued me a little bit, because I thought worst case, I learned something. Best case, I might make money, was being a financial advisor. Not knowing they take anybody off the street as long as you can pass a test with 70% and you're not a criminal.
Those are really the standards for a financial advisor.
That's it. Yeah. I mean, it doesn't take much. If you can last by being broke for a while, because you're essentially kind of begging for referrals, talking to your friends and family, calling out phone books, whatever you're trying to do to get leads, right?
Yeah.
I mean, that's kind of what I did. It was almost boiler room type.
You just described a few of my friends.
I know. I mean, imagine being like this 24-year-old kid saying like, hey, I don't know anything about investing other than what I just learned when I passed the test. You should invest money with me too, right?
Let's say you bring your 401k over to me.
That's right. So I actually did that for 4 years. I actually dropped out of college and never went back to finish my bachelor's, which would have been a sociology degree with a triple minor in psychology, Japanese, and ballroom dancing. So
Wow, actually, you probably should have finished that. That's pretty cool.
I know. It would be something to brag about for sure. But in any case, I went down that path. And 4 years in, my dad actually asked me, he says, well, Chris, when are you going to be my financial advisor? Now, I'd never seen his finances before because he was always very guarded. He always thought people were trying to take money from him. So I thought, all right, let's do this. I sit down with him at his kitchen table, the same one he told me to save everything, spend nothing, my massive experience with money. And as I'm sitting there with him, I noticed that he'd saved in his 401k for decades, got the match and everything, that brainless match that you're supposed to get, right?
Mm-hmm.
He had paid off all of his debt, including his house. He was mortgaged and totally debt free. You would think this guy was like Dave Ramsey's dream come true. In fact, he's older than Dave Ramsey. He probably taught Dave Ramsey everything Dave Ramsey knows. And so, but when I looked at his money, I said, well, Dad, you're 61 years old. If you want to retire today, you better hope you die in 5 years because that's when you're going to run out of money.
Whoa.
And he's like, well, what do I do then? Yeah, I said, I don't know. You did everything, quote unquote, right. Like you paid off your debt. You've been saving in the stock market, getting your free match with the 401k. I don't know what else to put you in. I can put you in this other stuff with stocks, but what if the market goes down? Which, by the way, 2 years later it did. So I dodged a bullet there at least. But I was like, I don't know what to do for you. And that bothered me. And it was just a few weeks later, I called up a friend who left my team. I trained him to be a financial advisor, but he left to go do this crazy thing called real estate investing. And I decided to ask him how things are going in his life, thinking that he'd be broke and he wanted to come back to work for me.
Right.
I got the opposite response. He's like, man, after just 4 or 5 months, my dad and I, his dad, right, and him had partnered on some deals, and they doubled his dad's income as a professor at the local university.
Wow.
I'm like, come on, that's too good to be true. There's no way that that's possible.
What year is this?
This was in the end of 2005, going into 2006.
Okay.
So it was like right before New Year. So I would call him up, kind of wish him Happy Christmas, Merry New Year, or whatever it is, right? So, so yeah, I'm talking to him about that. And he finally just asked me a few questions. He said, Chris, well, how many of your clients are actually financially free where they don't worry about money? I said, well, even the retired ones worry about running out of money too soon. So they all worry about it. Okay, Chris, that means nobody's financially free. Good job. How about this? How many of you as financial advisors are financially free, not off the commissions you're earning, but actually doing these mutual fund investments? And as I was really honest with myself, and there's probably about 100 people in our office, I said, I don't know, there's guys who've been working here since the late 1970s. So I would have to say none.
Wow.
There's your problem.
Wow.
And that's where I took the Matrix red pill, right? And went down the real estate rabbit hole and realized, because here's the thing, I like evidence, right? It's why I never went the employee path, because I saw I saw my future by looking at other people's lives. But if I looked at the financial advisors' lives, they weren't free either. So why would any of their clients be free? On top of that, real estate investors, there was guys in their 20s and 30s that were able to retire. I'm like, well, come on, like, okay, I got to follow the evidence, right? Tony Robbins says success leaves clues. And so I did that. I started learning what they did. And there were more flippers and stuff, but that opened up my mind, because even those flippers were asking for hard money. And they'd say, hey, well, what if I paid you 2% a month or 24% a year for that hard money? And I started doing the math. I'm like, wait, even if I give them $100,000, that's $2,000 a month. I only need $3,500 a month to feed my family, and I could retire. And so between that and some other things that I started doing later that next year, I had enough passive income coming in that I was able to retire at 28 years old. And that blew my mind. By the way, at this point, I'd already quit being a financial advisor too.
Okay.
Just to be clear.
Let's talk about that for a second. So how, from the time that you took the red pill and said, real estate investing, there is something here that this could take me down a path to be financially free faster than being a financial advisor. From that time to 28, how many years was that?
Well, I was financial advisor for 4 years till I was age 28. But by the time that I first talked to my friend about that, where he kind of called me to repentance, so to speak, to the time I was able to retire was about 7 months.
Wow.
So how were you able to retire that early then?
Well, like I said, $3,500 a month is a lot easier nut to crack, versus like now with a lot of kids, I need easily $15,000 a month, right? But back then, like, it was really just getting my money out of prison, as I teach people today. It's like, because everything we taught as financial advisors, and even the things that people have been taught their whole lives by financial experts in the media, is to put your money in prison, right? Lock your money in equity in your house, pay that sucker off and get debt free. Lock your money away in 401ks and IRAs and all that kind of stuff, and that's what I had been doing for those years, is I was just locking money away. But when I realized, like, for example, and actually I'm going to save the example for a lesser pocket segment, but because I did a real estate deal that was pretty creative, but it also backfired on me. But if I realize I can cash out equity for my house, right? Cash that money out and then invest it and create arbitrage by, because I'm paying almost nothing for that money. And then that money is able to come back and I'm able to make money off of that. I mean, not to mention any other cash savings you have too that you could turn around, create passive income off of. So I mentioned like lending was one thing, right? Also having rentals, so like I actually turned my first property into a rental to actually create passive income there too. So just doing those kind of things, and even just looking for ways to just, again, like, how do I get creative? How do I find ways to create enough passive income where I'm work optional? I work because I want to, not because I have to. And so that's really how I did it. I didn't even do a whole lot with the flipping side, although I did wholesaling back then, not knowing I was doing wholesaling or a version of it. I was doing a little bit of that too. So that was helping build up the cash to then turn around and invest for passive income.
So after you quit your financial advisor job, what did you do? I mean, you said that you were financially free, but what were your next steps? What did you start spending your time on? What did you start building? Or how did were you just trying to network with other investors at that point? Or what was the steps?
Exactly. Yeah. So like my friend was already in a real estate group that was teaching a lot of stuff. So I started picking his brain, but just, for a few months, I was trying to make both worlds work. I was trying to be a financial advisor still, but I stopped attending their trainings. Ironically, when I stopped going to financial advisor trainings, I made more money in my financial advising business. So I actually left at the height of my practice when I finally just called it quits. And the thing that got me to call it quits was actually going to a real estate seminar that these other guys had put on. And when they started calling all the bull about, like for example, you always hear in financial advising, you're in it for the long haul. Well, if the stock market goes down, how long does that long haul become? Right? Like it can become a long haul, right? Like literally like the year 2000, if you look at like the S&P 500, it didn't recover until 2013. But because most people had costs and stuff coming out, plus whatever, if you have 401ks, they're even worse. They underperform the stock market. So that even if you get the match, you barely make up for the bad performance, right? But for most people I talked to, if they had 100 grand sitting in 2000, it took them till 2015 before they had 100 grand again in that same account.
Whoa.
That's the long haul. That's what my dad was caught in, right? Because he was like trying to invest in like tech stuff, because in 1999, everybody's making money in tech stuff. So he switched in the year 2000 to tech, which tanked like 80, 90%. Wow. So part of the problem that happened to him is that he lost a crap load of money in the tech sector because he just heard other people making money. So he switched his portfolio over right at the height of the hype, really, not even the height, but the hype of the market. So anyways, long story short, like I was learning about that stuff and then learning about, high risk creates high returns. It's like, well, when does a 90% chance of losing become a 90% chance of winning, right? The only people who want you to take high risks are the people that are like the banks and the financial institutions that want you to take all the risks so they don't have to. Because if they believe in high risk creates high returns, they wouldn't actually take guaranteed fees off your money, of your assets under management, right, as they call it. They wouldn't take those guaranteed fees, if you lost money too. They would say, you know what, if you lose money, we don't take any money out, right? That would be the nice thing to say. No, they take money out whether you make money or not. They let you invest your money in the stock market while they don't invest any of their money in the stock market.
I think one point that I would like to just kind of extract out for our listeners at this point is whenever the conversation about the stock market and contrasting that with real estate comes up, one of the things that I realized is, so, we say, hey, you need to invest for cash flow. That's the big real estate kind of mantra, right? And then sometimes you'll get a quick fire back from somebody who's in the stock market and they'll say, well, I have dividend stocks all the time and those pay me X% in dividends, right? And that's their cash flow. But the next, like there's two more layers that you don't understand and that often don't get talked about. And one is that you cannot leverage that stock like you can real estate. And so when one of our investors, who's probably one of the smartest guys that I know, and like, I don't know how to say this, like he's like low level smart. Like I don't mean that as a negative thing. He's just learned, like he's been a student for his whole life and he's found people that have been smarter than him and he's executed on what they've said. And he didn't come up with these original ideas, but now by implementing these strategies for a long time, he's one of the smartest guys I know. And he was talking about, and I've seen this with our stuff, when you put debt on something, you have fixed in the cost of that money with real estate. And then as inflation goes up, your debt doesn't increase if you do it correctly. And so like you don't get that in the stock market. The tax benefits and the depreciation that way. It's like depreciation in 27 and a half years, your property didn't like dissolve into a pile of rubble. It's worth more then than it was at this point. So you put all those things to work and it has a disproportionate effect to the stock market. So I just wanted to break that down for people who often hear that real estate is superior and they're probably asking themselves why, or they're kind of like pulling back to make a defense of the stock market. And there are, I'm sure, benefits to that, but there's a lot of things in real estate. You start pulling those levers, man, and it gets pretty crazy.
Well, and I think the average consumer, they invest in the stock market because, to your point, Chris, they're told to invest in the stock market. What do you do? Yeah. Well, you do a retirement account, you do an IRA, you do a 401k, and it's just, if you don't know what you're doing, you're going to lose money. Same thing in real estate. If you don't know what you're doing in real estate, you're going to lose money. And so I've seen that in myself. I was like, I don't know what to do. I'm just going to put it in these stocks. And then, I lose money and I'm like, probably shouldn't do that because it's not what I know. And so there's something to be said too, sticking to what you know and not just trusting a financial advisor or trusting someone else to make you money, because at the end of the day, the buck kind of stops with you.
That's right. Well, let me pull back the curtain. I'll use that to kind of, in a roundabout way, still answer the question of what I did, right, to get out of there. Because at the same time, I was actually not just a financial advisor. I was also actually investing in stocks and options. In fact, I was teaching and training people how to buy and trade stocks and options. So I was like a stocks and options trader. I was the guy that raved about the stock market. I was the guy that would show you those, what they're called Ibbotson charts. If you ever seen it, like you invest $1 in 1928, and they show you like with inflation, you got like $15, $20 today, right? And and that's $1 in real estate would do you just slightly above that. And there's T-bills, and then you have stocks all the way up that skewed scale. Like you have $1, you'll make $5 bazillion, in 100 years, that kind of thing, right? And so I would quote that all day long to people saying, well, yeah, you don't want to do real estate because look how much it appreciates. It's like maybe 4% a year if you're lucky, right? So that's barely, that old inflation, which we know that's fake inflation too, reported by the government, right? So I was teaching that stuff. Like I was telling people like, there's no way. But you're right. Like what you just brought up a memory, because I remember going to a real estate seminar while I was a financial advisor before I finally jumped ship, right? A different one. And I had a little aha, but I didn't want to see the aha as a financial advisor, because financial advisors, the reason they don't recommend real estate is because they don't get paid for you to invest in real estate. We get paid for you to invest in our stuff. And the only thing that they let us legally get paid on is pretty much stocks, mutual funds, bonds, the traditional pieces of crap that you're always told to invest in. High risk, mediocre returning kind of crap that you get, right? Well, so when I start hearing them say, well, with real estate, there's more returns because, you get cash flow, which they didn't even talk about cash and cash returns. They just talk about appreciation. Right. Because he said, if you buy a $100,000 property and you put 20% down, you put in $20,000. Well, what happens if the property appreciates 10%? Right. You make 10%? I'm like, yeah, that's 10%, over however many years it'll take you, but stocks are better. And he's like, but you didn't make 10% because that $20,000 you actually invested, because you're leveraging the bank's money for the rest of it, that $20,000 actually increased by $10,000 of equity. That's a 50% return. So if you only put 20% down, you get a 5x multiplier on your returns on that money.
Before any cash flow.
I was like, hold on. No, that's just too good to be true. My financial advisor brain was like, no. Or yeah, sure, that's great, but your money should be in stocks, still, because that's where I make money. Don't you go into real estate, right? And you're right. Like there's the cash. I mean, I did this comparisons like 6 years ago. I bought a turnkey real estate property. I don't like to manage my own properties because I suck as a manager, because I'll buy any lame excuse a renter gives me for not paying them. So I decided I was better to invest in property managers. And so I have this one property in Memphis, Tennessee, for example, where I bought it exactly just 6 years ago. And I compared it to the S&P 500, which is, by the way, the S&P 500 outperforms 90% of mutual funds. Okay. Wow. Most mutual funds don't even get the S&P 500 returns. Wow. So I was like, let's compare the same $32,000 down payment I did with that property into the stock market. The stock market would actually nearly double by this point in 6 years. Like it was like that 32 would become $63,000 in the stock market, assuming there's no fees. In my real estate, however, because of the cash flow I'm getting, which by the way, my cash flow now on that property, I'm making like 8,800 per year on that 32,000 down payment because the rents keep going up each year. And it's the same freaking renter I've had for 6 years, which is awesome. Doesn't
Yeah.
always happen that way, but I like it. On top of that, they're paying down my mortgage for me, right? There's the mortgage pay down. So equity's building there, even if there's no appreciation. But when you factor in that I had appreciation too, I made over a 300, almost a 400% return on my money in 6 years. That sounds too good to be true, but that's just freaking reality, right?
Yeah.
Remember, the stock market did better than it normally does too. When it nearly doubles in 6 years, it doesn't usually do that. It usually takes closer to about, roughly about 10 years, 9 or 10 years to do that. It did it in 6. Well, same thing with real estate. Even though it was a little bit more than usual because of COVID and all the money printing that happened, still, I made a lot more higher returns and I'm making more income. That's the big key thing. And this kind of goes back to answer your question, right? Is that it's the income. Like you said, it's the cash flow, right? It really is the passive income that comes in that creates your freedom. Because when you have more income, you have more options. And when you have more options, you have more freedom. Because I, as a financial advisor, always thought you had to save and squirrel away your money, save into that little nest egg for, 30, 40 years. And then hopefully someday you've got something to live on. And remember, financial advisors, the more up-to-date, more accurate financial advisors, including a guy on Dave Ramsey's staff who got blasted by Dave Ramsey for teaching truth, go figure. They talk about 3% is all you should be pulling out from your mutual funds. So if you're lucky enough to save $1 million in the stock market, which, by the way, only 1.5% of people with Fidelity 401ks and IRAs have actually done this.
Wow.
1.5%, right? Hit $1 million. You're only going to live on $30,000 a year.
Wow. Well, when you add that to Social Security, you're probably going to be at like 65,000 a year. So,
Exactly.
it's just
average Social Security doesn't pay much either. Yeah.
And that's when you start pulling back the curtain. I know this is kind of a core level episode on what are all of those fundamentals working together, and you have to like almost revisit these. So as a case study, I can attest to this. It is amazing what one rental property can do when you put all these things in together. So my in-laws and I, we just recently together, my wife and I and my in-laws are 50-50 in a partnership. And we started with a down payment of like $20,000, which we split 50-50 on one property, and then a down payment on a duplex that was like $40,000. So as a partnership, we're in it for $30,000 apiece over the course of 4 years. And we've kind of slowly and organically grown that to 10 units. We just purchased our 10 unit. And we have funded all of the remodels and everything out of the cash flow. We've not had to do another cash infusion at all throughout that time. And we put $60,000 into one building. A month ago, we just did a line of credit on one building for $170,000. So now we have that to go and put to work. And so it's like we kind of hit that point. And here's the thing about real estate. It really is not a get-rich-quick thing. It's like any business. Any business is going to take you 2 years of consistent, hard effort before you crest that hill. And real estate's no different. That's what we've seen. So now that we've crested that hill, we're 3.5, 4 years into our partnership, and it's going to be that hockey stick growth because of the equity appreciation, the cash flow. So like I've seen it work for my own personal wealth, and it's not just some guy on YouTube that's going to make money when you sign up for his course.
That's right. It's true. Like, there's a lot of BS out there, of course, in the real estate game because people try to oversell. Like, hey, this 2,000 made me a millionaire. Like, well, okay, let's be honest. You worked your tail off to be able to do that, but but it's true. Like, there is so much more leverage, and you said something earlier that also brought up a good point as well. That if you want to know where the best place to make money is to invest, follow what banks do. Like, and in fact, ask a bank, like, where would they lend money? Will a bank lend you money to put in the stock market? The answer is no. Now, I know there's going to be a few stock fans that are going to argue this. They're going to say, but you can get a trading account where they'll basically give you a 50% extra leverage, right? So if you have 100,000 sitting in a trading account, they'll let you borrow 50,000, but There's a but there. They can do what's called margin calls, because if the stocks that you're invested in start to tank, they can all of a sudden say, nope, we're taking our money back. And then you get everything sold. So you can, yes, you can increase your returns and maybe even possibly double your returns faster, or you can lose almost anything. Because I had a student that decided to trade options without getting trained. He did it before I even got to coach him. And in 1 week, he lost 90% of his money trading with debt, essentially, right?
Wow.
Lost it all. And then when
Probably
they did
didn't
the
even
margin
know how
call,
it happened
boom.
either. I mean, it happened so quick that you're like, what? How did I even lose 90%?
Oh yeah. Yeah. I even had friends that worked for companies that taught people how to trade at stocks and options, and they would lose their parents' money even. And these are people teaching you how to trade, right? And so, and I was in that business too. I was there. But watching that, it's like, well, banks never really lend you money to do those kind of things. But what would they lend you money for? They will, as you mentioned earlier in the podcast, for all those that are business owners, you can get money for a business loan. Now you have to really justify it, but they'll lend you money. But the one that's the easiest is real estate. They will lend money for real estate. They won't. In fact, if you try to go and borrow money, say, I want to borrow money so I can invest in the stock market, they will stop you. Because when I was a financial advisor, people would sign a form before they would invest in mutual funds saying, I did not borrow money to invest. But with real estate, it's actually encouraged.
Right.
It's a different game, right? Lower risk. And again, it's about that cash flow, that profit you can make, right? Where in the market, you're gambling. And let's be honest, financial advisors, I know I was one as well. We don't know if it's going to go up or down. We're just guessing like you are. We're no more educated, really. And if you really if you really get down to it, I mean, yeah, there might be slightly bit more education there than the clients that we work with. But the truth is that we don't know what's happening. We're not fortune tellers. We just say, well, keep saving. Dollar cost average, because eventually do it. Well, if dollar cost averaging really worked, you know what you would tell people to do? Wait for a market crash, save up all your money, dump it all in at the bottom, and then ride it up, instead of trying to buy it at all-time highs too, like it is right now. That would be dumb to do. It's like buy high, sell low. No, they just tell you put it in because they don't know what's going to happen, and neither do you. So just because you're guessing, you're gambling, just throw money out all the time, which is great for a financial advisor who gets paid all the time every time you put money in, isn't it?
You need to go in eyes wide open, and you have to learn the principles. And just to summarize what we've been talking about before we go into our show segment is invest in Bitcoin. So
that's right.
Just kidding.
So I'll bring it back to this. So my big aha was about the cash flow, right? Is that, if I had $1 million, I didn't have $1 million. I had more. I didn't have that much money. But say you have $1 million for easy math. $1 million, you're pulling out 30,000 in the stock market. Well, what if that $1 million you put into even invest with doing a hard money loan, getting paid 1% a month, or into a property that gets paid 1% a month? Now you're not making 30,000 a year. Now you're making 10,000 a month or 120,000 a year with the same money. And the big thing that brightened my day, that just like the heavens opened and the angels were singing, right, was when all of a sudden I realized, wait, I don't have to save up $2 million to hit 5,000 a month of passive income. Like, I don't need that. That's what I was thinking in my mind. Save up $2 million, turn off the heat in the winter, turn off the AC in the summer so I can save up enough nickels to put together and throw it in the stock market and ride enough waves to eventually I'll make enough money to retire, right? That's a crappy way to go. And not to mention, I didn't even factor in inflation, because 5,000 a month is crap now. I thought that was living the dream 20 plus years ago.
Right.
So what happened with me is that, again, pulling money equity out of my house, right? I was able to get money out of the house. I was able to take whatever savings I had, and I was still stock coaching. So I was still making money stock coaching, even though I quit as a financial advisor. I was a stock coach still with a different company. I also was doing mortgages because, in 2006, anybody could do mortgages because anybody could get a mortgage.
That's the problem. Yeah.
Yeah. There was awesome time to be in the mortgage industry. I'll tell you that much. So, I was still making good income, and I was able to turn that income and invest it with others as well to create passive income that way. So doing hard money loans, and some of those guys were paying like 2-3% a month.
Wow.
It was insane, and it wasn't sustainable either. So that's basically how I did it, right? I had a few other like income streams coming in on the mortgage side where I actually stopped doing mortgages, but I had the mortgage license and let everybody else do the work. So I started making a stream income, like maybe 1,000 or so a month doing that. But it was really just the combination of that. I was making 4,000 or 5,000 a month, working almost no hours a week, maybe a couple hours a week at most.
Wow.
And that's what blew my mind, was that I didn't need as much money as I thought to be able to create the income that I needed. And And that's what I teach people today, right? It's the same thing. And yeah, we even talk about infinite banking and stuff too, and how you use that to get your money to pay you in two places at once, kind of basically enhance your savings. But that's not the answer either. If you ever hear people talking about infinite banking, like, using whole life insurance to invest and stuff, I'm telling you right now, that by itself will not make you rich. The thing that makes you wealthy and rich is investing in the thing that you guys talk about, which is the real estate, buying cash flowing assets, using that to work in your favor.
I can already tell you and Dave Ramsey would really get along.
Oh, we'd be
all right.
best buds. I can tell you that much.
All right, we're going to jump into our smaller pockets segment. So, Chris, go ahead and tell us about a deal that went wrong. What was your worst deal? What happened? What went wrong? And then what did you learn from it?
Yeah, my worst deal was initially my best deal, but it became my worst deal. So I mentioned I got equity out of my house. Now, here's how I did it without having to pay anything. Is back in again 2006, anything goes, right? Even as an investor, you could go with essentially a 0% down payment, right? And so there was groups out there that said, hey, we'll connect you with investors that will buy your house at full appraised value, and then you lease it back from them. So I'm like, oh, that's creative. I can just sell my house and my property. Look, in hindsight, I probably should have just done that. But I thought, well, this is a way I can even make more money, because I can then sell my house at full appraised value, get all my equity out of it, pay them a lease fee, but then go and sublease the house to a renter to get cash flow on that side.
So complicated.
Right? So creative strategy, you're like, hey, this sounds
was a
pretty
real
cool,
thing that
doesn't it?
investors were trying to do.
I'm sorry, say that again. Ask
Like
that
this
again.
was a real thing that people were doing. They were offering this kind of product, like we'll buy it, you lease it back, and then you were taking it a step further and saying, oh, I'll sublease it.
Exactly. So the way the deal worked a little bit more internally is that the investor that bought at full appraised value, they would have their mortgage payment, but we would agree to pay like maybe about 10% above their mortgage payment. And of course, because there wasn't really any money out of pocket, because they could do 0% down loans if they had good credit, even on investment properties, they're like, well, hey, no money out of my pocket. I'm making an infinite rate of return just using my good credit score.
What could
Right.
go
And then
wrong?
make money because it's 10% or so above my own payment. So I'm basically making an infinite rate of return, even if it's piddly change, right?
Interesting.
Makes sense
So-
why some people got in trouble.
Yeah, exactly. Well, especially when the whole thing blew up, right? Because ultimately they still have the note, they still own the property, but then I rent it from them. But I was moving out into another house at that point. So I decided I was going to sublease it to another renter. And they all knew this. This was everybody knew this was what's happening, because that was one of the ideas mentioned is, hey, you can even lease the property out, rent it out. Well, I did. And I rented it out to somebody who wasn't the best of renters. I should have known when they said they were getting government assistance for their other place. But I thought, that's kind of like Section 8. So it's all good. Not
Guaranteed
really,
money from the
'cause they only
government.
covered half the rent. Yeah. So long story short, of course, remember, this is 2006. Well, 2007 going into 2008, everything's starting to become a little wonky, right? And it was about the end of 2007. I'm like, okay, I need to evict these people. They aren't paying rent consistently. And I go to the property for the first time. I try to do like a cleaning check one time. Again, I'm not a good property manager. I just want to make sure I got my checks, even though I live literally 5 minutes away from the house. So I go through the property after I finally get them evicted. They had trashed the place, holes in the wall. Pizza was frozen on the carpet upside down because obviously it was wintertime. There was the only thing that was really well built was the dog house that they built, which of course there was no dogs allowed, but they had a dog, right? So of course there's dog poop in the house too, and they didn't bother cleaning that up. So, and the first time I walked through was actually with a potential buyer. So I was trying to help the investor out by helping him sell the property, even though it was in his name. I didn't want to leave him hanging. And I'm walking through these people, and I'm literally about crying when I see the condition of this property. And so I'm just feeling horrible. I paid 1-800-GOT-JUNK. I paid them to do all the junk removal and stuff. And at the end of the day, we were lucky. We kind of broke even on the property because the real estate market hadn't tanked completely by that point.
Wow.
It was a lower priced home. But man, I would say that was my worst deal because, I got the equity out, but the stress of that, even the owner, he was just like, hey, with all these extra expenses I've had on my end, maybe you owe me like 15 grand. And I was like, dude, I'm going broke right now because the real estate, we can't flip, we can't do anything anymore. It was just, I actually went from millionaire to upside down millionaire during that period of time because I went over $1
Wow.
million in debt as I watched my real estate values tank. And not to mention, I started a brand new business teaching people how to get out of the rat race, and then I'm back in it. So, I mean, that's a whole
Wow.
nother story. But it was a creative deal, but it was a deal that backfired on me because, again, there wasn't good enough cash flow on that property to really
Yeah.
justify keeping a renter there that wasn't paying me consistently anyways. And of course, I was banking on appreciation. And that's, I think, one of the biggest mistakes I made, but also learned from that. Now everything's about cash flow, profit, day one, not hoping that appreciation will save me. I always focus on what's the profit and will
Yeah.
they pay me? And let's get a property manager to do it for me so I don't screw it up.
Wow. Wow. So yeah, just to, for anybody listening, we always talk about I feel like it's my dad mode. I put my dad hat on. I'm like, the 3 immutable laws of real estate investing. And one is invest for cash flow. Number 2 is have fixed rate debt. And number 3 is have adequate cash reserves. And so there is a right way to do things.
Yeah.
And when you do that, it helps mitigate, not eliminate, but mitigate the risk of things that we can't control, like the macro level things that happened in 2008. That's a good story. I had never heard that.
Yeah, I've never heard of that either. That was pretty
investment
wild.
strategy. That guys were out there buying stuff retail because they could get into it, no money down with a loan, 100% leveraged, which that's a bad idea because you better hope nothing adjusts downward at all. Interesting. So,
And that's what it was. We're trying to do for sale by owner. Eventually there was realtor costs. That's why the guy was trying to sue me for realtor costs. I'm like, I don't even have the money to pay you. Sorry, man. And he eventually dropped it, but it wasn't a great deal for us. It wasn't a great deal for him. He made some cash flow, but he lost all that to paying realtor costs.
Wow.
there is another value driver that doesn't get talked about, and it's called peace of mind. And just because you can invest in something and it can make you money,
Does
if
not
it
mean you
costs you the peace of mind, you really don't have a good quality of life. And people have experienced that in different ways, whether you run a business that just is eating your lunch and you feel like a slave to it. Like, you got to have good peace of mind. And that's probably why it was stressful. I mean, he was trying to sue you, but really it was his problem, because you'd already gotten your money out, but you felt that obligation and you felt that looming threat of a legal battle. So that'll keep you up at night for sure. A great story. Thank you for sharing that. We are going to go into what we call our little nugget. All right, Chris. So this is part of our show where you give us a practical takeaway or a core principle that you operate your business by that people can apply to their businesses.
Yeah, I kind of alluded to this when I talked about the lesser pockets aspect too, right? It really is about profit. Even in business, it's really about what's the most profitable activity you can do. A great book I would recommend that talks about that is called The Pumpkin Plan by Mike Michalowicz. Same guy that wrote Profit First, which is another great book you got to read in business too. But The Pumpkin Plan was a big aha for me because I realized it's that Pareto's principle, the 80-20 principle you always hear about, that the top 20% pays you 80%. Same thing in business. It's like, what is your real good cash cow? Focus on that. And that's true in real estate. Focus on the areas don't go venturing out. If you're a multifamily apartment guy, don't go do hotels. Don't go buy coffee farms. Don't go buy marijuana farms. Like, stay in your lane, get really, really good at what you do, and you'll find out you'll keep money and make more money too.
I would argue too that applies to somebody who has a high W-2 job that they actually enjoy. There's always this stuff on YouTube like, go be active investors. And it's like, man, if you have something that's paying you and you enjoy it, keep driving that thing. Because, I took a little of a different approach where I got into real estate. And so that was both my income and my investment strategy. So I was funding my investments from the same industry that I was getting my income from. And that's a little bit of a different approach than what I see a lot of people do, where they maybe work an outside job, corporate, they make good income, and then they put it into real estate. And neither's right or wrong, because there's times where I'm like, man, it would be nice to have, more stable, higher income to be able to dump into real estate. But I had to realize, for me to pivot, I would be starting at zero again and have to climb a corporate ladder. There's a law of compounding returns. I've already put so much energy into this field that I need to let it work for me. So there's that aspect of what pays you, sticking with it. And there's always a way to get into real estate, whether it's from a passive vantage point or an active vantage point, so you can get in the game. What's been one of the best resources in your business development?
Lately, it's been really masterminding with others. in the same space, right? Like I still hire coaches, like one-on-one coaches. I just said this to one of my team members today. I said, the fastest, the cheapest, and the easiest way to make more money is to mentor with somebody who already paid the price to do it, right?
Wow.
And whether that's a mentor, like I love paying for coaches and mentors, especially if they've been there, done that, and they're still doing it today. But also, even if you're there's a mastermind type of group or community that you're a part of, learning from them, gaining from their experience and their insights. And they don't even have to be in the same industry. Sometimes the best ideas come from outside your industry. So that's what I've learned has been huge.
Can I ask you just maybe a clarifying question on that? Because
yeah.
I think somebody could hear that and feel like conflicting advice. On one hand, you have somebody who they're the guru, there's somebody who's selling a product, and they're luring you in with their coaching service that actually is not what you need. But then what you're talking about is there are legitimate people out there that are worth paying. How can someone know the difference?
It can be tough because I'll tell you, I run into this all the time, even in my industry, right? Like there are people that have great marketing. They say all the right things, but they don't fulfill that promise. And sometimes the easiest way is just to look online, ask around. Birds of a feather flock together, right? I don't want to name names. I just thought of a guy's name. He's in the real estate space. He's pretty popular. I won't name names, but I've been a friend of his for 15 years. I don't spend time with him though, because I know his business love language is just make money off people, and he'll essentially rip people off, make them pay $50,000 for a real estate program that really they might get paid if they're lucky 5+ years down the road, right? And I was like, that's if they pay it, if they know what they're getting into, that's their prerogative, right? But there are good people out there, and they're often not the best marketers. Sometimes they're just really good at what they do.
That's true.
Sometimes there are really good teachers, right? There are those too, but I'll tell you, like the best ones is like success leaves clues. Like they will have happy clients, and they may not have the most clients, but they'll have happy clients. They'll have people who will say, this was worth it. In fact, I know some people actually question ours because they'll say, I looked online everywhere for a negative review. I couldn't find it with yours in your coaching. I said, there's one. Go to Facebook. There's one negative review from a guy. You'll see there. And you know what? And I'll just tell you right now, it's like he actually made a lot more money than he paid us, but he just wasn't happy because it wasn't the results he was wanting from a certain angle. He was expecting something, got something different. It was better than he expected, but it was worse because he wanted that one thing. And so I was like, I have one, so you can believe it's real. I'm not a 5-star person. I'm like a 4.9 star person thanks to that guy.
Oh, sue me. I'll take it. You know what I mean? Like,
I know. Exactly.
And I think that's something too that you mentioned is they'll have happy clients. For as much as we have social media and you can pay to play on ads, for Google and different stuff like that. Here's what we learned on YouTube or anything. If you have enough money, you can make yourself look like anybody you want.
That's right.
To the point where it's like all of our views could be artificial and all this different stuff. So there is an organic part to business that has not gone away. And talk to somebody. Like some of the best resources that I've been connected to are other people that are my peers, and they have had firsthand success or experience with this coach, this resource. That's invaluable. Because now I'm talking to a real person, not a bot that could have an AI-generated review that they screenshotted and put on their website, So there's an element and a relational aspect to this that I think is always there. Chris, how can people find out more about you and follow your success?
The best way is look up Money Ripples. It could be moneyripples.com, @moneyripples on all social media, or even look up our Money Ripples podcast on YouTube, iTunes, wherever you consume podcasts.
Awesome. Well, we will put those things in the show notes. And Chris, thanks for coming on and sharing your story today with our listeners.
It's been such an honor. Thanks, guys.
As always, excited that you joined us for another episode of the Reinvest Podcast. Stay tuned every Tuesday for new episodes. And if you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, lv5capital.com, and shoot us a message. Move farther, reach higher, and grow deeper. We'll see you next time.